So Lemonade is set to launch soon as the world's first insurance carrier designed from the ground up for the sharing economy. But I'm not going to talk about Lemonade per se. What I would like to talk about are dramatic advances in disparate domains, which are converging in ways that could be transformative for the whole insurance sector. Let's get my clicker out. And I'm going to try and weave together disparate elements. So we're going to talk a little bit about evolutionary psychology, but also machine learning, behavioral economics and game theory, social networks and social impact. And we're going to see how the confluence of all of these could be a harbinger of true transformation in insurance. Now, the prize is worth the effort. Not many entrepreneurs are taking on insurance today, but for us, it's the Holy Trinity. It's the most exciting domain that could be because it has the following three characteristics. Endless sums of money. We're talking about a multi-trillion-dollar industry. Just to give you a sense of things, we're talking in non-life insurance about what we would call gross margins of close to $1 trillion. Close to $1 trillion of gross margin. That kind of plenty is residing atop of a bureaucratic, centralized, and very opaque business model, the very kind of business model that is most susceptible to the kind of exponential disruptions that are being discussed at this conference. And to dovetail to that is the second point, which is that this is an industry largely unspoiled by innovation. So the Fortune 500 is made up almost 10% of insurance companies. Their average age is 95 years old. The incumbents are vestiges of the Industrial Revolution. Their corporate structure, their business structure, the business rules, everything about this industry screams early 1900s rather than 2000. So tremendous opportunity for change and innovation, potentially even disruption. And the third element, you'd say, well, if it's huge and it's been going on for a long time, leave well enough alone. If it ain't broken, don't fix it. But it's profoundly broken. This is one of the least loved sectors. You've got a reservoir of ill will towards insurance companies throughout the sector. Most Americans will tell you in survey that they consider insurance to be a necessary evil rather than a social good. Most Americans do not believe their insurance company will pay them when the day comes, which is kind of fundamental to the whole business model. So when you take the confluence of those three, when you take endless sums of money, unspoiled by innovation, and with a deeply dissatisfied consumer base, it becomes very attractive to investors, to entrepreneurs, and that's really what I want to talk about. Now, the way I categorize the opportunity in insurance is simply by looking at where the premium dollars go. So the column on the right-hand side talks about your premiums. In Lemonade, we're focusing on what's known as P&C insurance, property insurance. Let's take as an example homeowners insurance. The national average in the US is $1,000. It's a nice round number. Roughly a third of those $1,000 that you pay your insurance company for your home insurance goes on what the industry calls its expense ratio. That's paying for the expenses of running an insurance company. Salaries, all that kind of good stuff. The nice big towers that they build, almost always the biggest building in town is the insurance company to try and impress us. The private jets, the big fat bonuses, the whole lot is rolled into the expense ratio. Roughly a third of your dollars are going right there. The other 2/3 are what's called the loss ratio, and that is being paid back out in some form or fashion. Some of it is paying for that house that got burnt down and now needs to be rebuilt. But an alarming amount of it is going out in fraud and fraud mitigation, a point to which I'll return to very quickly. So, assuming for the moment that the risk of your home burning down is a given, and it isn't, but let's just assume that that is a given, there are still huge buckets of money in your premiums that can be collapsed in a very dramatic fashion. And what we're going to talk about now is the kind of disciplines and technologies needed in order to collapse an expense ratio and to collapse the fraud. So we'll talk a little bit about exponential organizations. I know you've heard about that, but I'll talk about it in the insurance context. And I wanted to start off with behavioral economics, which is less obvious. So in getting the pulse of the people, it's always nice to go to the Urban Dictionary and have a look at how people are defining different terms. This is the Urban Dictionary's definition of insurance. A business that involves selling people promises to pay later that are never fulfilled. And this is the first definition there. And of course, it then gives you an example of how the term is used. Goma paid flood insurance premium for years, but then the insurance decided to go out of business when the flood came because management had spent all the premiums on hookers and private jets. And as hyperbolic and dramatic as that is, there's more than a semblance of truth to that, and it is reflective of broad perception of the industry. At Lemonade, we're blessed to have as our Chief Behavioral Officer, Professor Dan Ariely. Professor Ariely is perhaps the poster child of behavioral economics. He's professor of psychology at Duke University and is, I think, the most popular and well-published expert in the domain. Of particular interest is his most recent book, The Honest Truth About Dishonesty. And Professor Ariely has spent years trying to map out what it is about human beings that brings out the best in them in some circumstances and the worst in others. And you can see a statement here, which is that after years of research, he came to the conclusion, it's kind of unnerving, that if you set out with a purpose and the design of bringing out the worst in humanity, you end up with a system that looks remarkably like insurance. And just think about it yourself. Insurance fraud, guys, is not the Russian mafia. It's the people in this room. It's you and me who regard ourselves as law-abiding citizens and feel very proud of and righteous and even self-righteous, except for when it comes to insurance. Oh, and we'll exceed the speed limit. Those are our two vices. What is it about insurance that allows people who in other domains of their life are good, upstanding citizens to suddenly let their demons loose when it comes to embellishing their claims in insurance? Well, we've spent a while studying this, and as I say, Professor Ariely has done deep work on it. And the costs are simply staggering. Nobody really knows this is an underreported crime. 25% of Americans, though, when asked, say that it's okay to defraud insurance companies. Presumably, the other 75% were brought up not to admit that kind of thing to strangers. But the mere fact that 25% of people say it's okay is pretty amazing. You know, insurance companies have been running big campaigns saying that insurance fraud is not a victimless crime. And they're simply missing the plot. Nobody thinks it's a victimless crime. People think it's a righteous act. So that's one statistic. The other one is taken out of Wikipedia. There are various studies trying to quantify it. One of the studies suggests that 38% of the money in the system is consumed by fraud. I can't defend the number. Nobody really knows, but it gives you a sense of the order of magnitude we're talking about. And New Jersey is running a campaign right now on the streets of New Jersey saying that it costs the average person $1,300 per year. So in any event, it's a big number. You put that writ larger than industry, you're talking about hundreds of billions of dollars a year. This is really a very, very large issue. If you can resolve it, the prize is certainly worth the effort. But frankly, the numbers understate the problem in a very important way. The problem with insurance isn't simply that money disappears as fraud. It's that it corrupts and poisons the entire relationship and experience. And when you have a product that you don't believe in, and when that product then becomes adversarial, then you end up with a product that sucks. And you end up with it being underused, overpriced, and people are resentful of the product all along. And the root cause of this, if I had to put my finger on the root cause, is a conflict of interest that is at the very core of the industry and of the business model. And it's very simple, and I'm going to say it in a somewhat provocative fashion. Insurance companies make money by denying claims. Every dollar that I, as an insurance company, do not pay you drops to my bottom line. Conflicts of interest don't come more clear-cut than that. Every dollar I don't pay you drops to my bottom line. So as soon as you've got that kind of moral hazard built into the business model, nothing good is going to flow from that. And you as a consumer are going to know that. You're going to embellish your claim and feel righteous about it. I'm going to be incentivized to try and deny or delay your claim as best I can. It's one of the reasons it has to be so regulated, because the incentives are so perverse. I'll give you a different way of thinking about it. And this is some of the behavioral economics. I mentioned kind of game theory as well. So you know the prisoner's dilemma. I'll give you another game that you may be less familiar with. It's known as the public goods game. So the public goods game says the following thing. Simple experiment that's been conducted time and again. I have 10 people around the table, and I say to you guys, there's a simple rule. There's an envelope here. You put up to $10 in the envelope. I'm going to take the contents of the envelope, double the money, and divide it by the participants around the table. So what happens is everybody puts in $10. I take it, I have $100. I double it, it's $200. I divide it by 10, it's $20. I give everybody $20. Everybody's a winner. I say, guys, we're going to do that again. Everybody takes that $10. Everybody gets it doubled. Everybody makes $20. Everyone's a winner. On round 3, Jimmy is the smart aleck who figures out that he can game the system. He doesn't put his $10 in. Now there's $90. I double them to $180. I divide them by 10. It's $18 each. But Jimmy has the $10 still in his pocket. He's gamed the system. He's got $28. So now Jimmy has figured a way to game the system. The only problem is that on round 4, 4 other people don't put $10 in the kitty. By round 5, there's no money in the system whatsoever. And what you see with these kinds of experiments in game theory is that systems have points of equilibrium. And the point of equilibrium in the experiment that I just described is 0. Everybody loses. And this is a fabulous proxy for what's happening in insurance today. There's plenty of money, but because of the perverse systems and the distrust that's endemic to the very business model of insurance, it drops to 0, and the point of equilibrium that we're at today, everybody's a loser. Insurance companies, consumers, and it's one of the reasons, one of the least loved and trusted sectors that are out there. The question then becomes, is there another point of equilibrium? Can we design a system with a different point of equilibrium? And this now enters into something called reverse game theory. So game theory is about playing a game forward and looking at the results. Reverse game theory says, I know what result I want to seek. Can you design me a game that derives that result? And that's a lot of what we've been doing at Lemonade. And I haven't the time to go into it in great detail, but these kinds of concepts, group bias, affinity, transparency, alignment, resolving conflicts of interest, adding meaning, adding purposefulness, priming, a whole slew of other key terms are the tools of the trade of redesigning the game. So I'll just touch on a few of them quickly to give you a sense of things, and you'll see how I'm kind of weaving in different themes, but hopefully they'll cohere and you'll get a sense of what I'm talking about. So evolutionary psychology. Darwin thought that there was group selection rather than just the selfish gene. That went out of fashion, it's back in fashion. We have an understanding now that primates, not just primates, but I'm picking on primates, primates can't survive solo. They need to, their optimal survival strategy is to cohere in a group. And chimps and humans will behave in fairly altruistic fashions within their group. They will sacrifice themselves for their community. They will do stuff, they will treat their peers in a way that is caring, respectful, and unselfish. But when one group of chimps meets another group of chimps, it's all-out war. Cannibalism, the whole 9 yards. And we're less different from chimps than we would like to think. In the 1990s, Robin Dunbar discovered that there's a correlation between primate brain size and the optimal group size for getting this kind of a behavior. And the Dunbar number for human beings is around the 150 mark. A little bit less, up to 200. But if you can have groups of those kinds of sizes, you don't need coercive policing, you don't need a tremendous amount of rules and law enforcement, and behavior is dramatically better than when you're in a massive, anonymous pool of people. I hope the metaphor is almost self-explanatory here. And that's one of the reasons why in Lemonade, we work very closely with real communities and trying to architect insurance in a way that can be meaningful at a Dunbar-sized group, which presents interesting challenges, because Dunbar is the law of small numbers, if you like, whereas insurance is all about the law of large numbers, which is why this requires major re-architecting of basic actuarial models. This is deep plumbing and new foundations. This isn't just sprinkling some new stuff on top. Now, the industry has residual memory that this is the case. What I mean by that is, insurance used to be that way. Lloyd's of London is famous, but there was actually a guy called Lloyd, and he had a coffee shop. It was called Lloyd's Coffee Shop, and people used to sit around his table in the East Docks, in the East End in London, before going to the New World in the 1700s. They'd sip their coffee, and they'd say, not all our ships are going to make it back. Why don't we pool things? And I'd say, I'm in, and I'd write Daniel on top, and then Jimmy next to me would write his name beneath me, and that was underwriting. And it was a group of people underwriting their names beneath each other and forming a pool amongst people who knew and trusted each other and had a shared interest. With urbanization at the end of the 19th century, everything changed. We became strangers one to another, and suddenly the big insurance company comes forward and says, forget all of that, I'm here, trust me. I'm going to build the biggest building in town in order to engender your trust. The sharing economy is all about rediscovering some of those elements of basic community, using technology to reconstruct modes of interaction amongst community members that once were prevalent. And that's what Uber is about, and that's what Airbnb is about, and that's a lot of what we're trying to do as well. So USAA and other companies knew that once upon a time, and they started. Geico is actually an acronym for the Government Employee Insurance Company. But of course, it's got much more affinity with a Cockney-accented gecko than it does with government employees today. Because the trade-off that insurance companies have to make is, do I want to grow or do I want affinity? If I just want 150 customers, or 25 like USAA started off, that's fine. But if I want 20 million, well, then I'm going to sacrifice Affinity, and that is going to damage the product and bring out all the ills that I described at the beginning. So it's a deal with the devil that the insurance companies have made wholesale, USAA being a bit of an exception, which is to say we're going to trade Affinity for growth. Growth trumps Affinity. Now, the good news is, and this is where some of the exponentials come in, that's true in the old economy, but it's not true in the new economy. You guys use Facebook. Facebook has 1.6 billion people on it. It's experienced exponential growth, but it has not sacrificed Affinity. When you go into Facebook, the people that you see are your community. And the reason that it's able to do that is because the marginal cost of spawning a new group is 0. The marginal cost of setting up a new insurance company is not. So insurance has grown by diluting Affinity and by getting millions of masses and estranged people into a pool and then having all of the psychological side effects that I described earlier. And Facebook avoided that. And once you can spawn groups at a marginal cost of 0, an interesting thing happens. Affinity no longer becomes an obstacle to growth. It becomes a propellant of growth. And you look at all of the elements of growth of Facebook and so many of the other exponentially growing companies out there, and you'll see that that's exactly what's lying behind it. I said there are two elements. One of them is collapsing fraud. And just to give you a sense of things, in Ariely's experiments, he found that using priming and a lot of the other buzzwords that I threw up there beforehand and that we're working hard to see how we can integrate, it's not that you reduce fraud by 5% or 10%. It can be binary. Because remember, we're talking about people who in other spheres of life behave well. And what you really have to do is create a construct that is similar to the rest of their life, and they'll behave well. And therefore, the impact, in terms of the financial impact and the impact on the experience, can be transformative. This isn't marginal impact. This can be very, very dramatic. The second piece of the puzzle is using the kind of stuff that you've been hearing about today and applying it to insurance in a way that hasn't happened yet. Geico has been running this campaign celebrating their 75th anniversary. They take it to be a matter of great pride that they're 75 years old. The year they were formed, in 1936, Ronald Coase wrote a seminal paper on the nature of the firm. He got the Nobel Prize for writing this paper, and it extolled the virtues of big bureaucracies and centralized organizations. And I have no doubt that when Geico was formed, they were using absolutely the best practices of the day because we've got a Nobel Prize to prove it. But guys, it's not 1936. And we've seen time and again how technologically based exponential organizations can be architected dramatically differently. It is difficult, not to say impossible, and Salim touched on some of this earlier, but it's difficult, perhaps impossible, to take an existing 100-year-old behemoth and turn it on its head. When you've got that albatross around your neck of that much legacy, it's very difficult. It's the Innovators Dilemma. It's almost an impossible place to get out of. But if you have no legacy and you're starting from scratch, you would never build an insurance company the way insurance companies today are built. They are, as I said, a vestige of the Industrial Revolution. So Encyclopedia Britannica was founded in the same time and same place as Lloyd's of London, the 1700s in London. And it did spectacularly well. It weathered the Napoleonic Wars and the Revolutionary Wars and 2 world wars and the Spanish flu and everything else until it encountered Wikipedia. And it's not simply that Wikipedia costs 0 and they cost $1,000. If I gave them both to you for 0, you would use Wikipedia and not the Encyclopedia Britannica. This is an unusual disruption. This is not the kind of disruption that we used to know in the 80s and 90s. This is not a low-end disruption. Just because it's free or cheaper doesn't make it low-end. This is a high-end disruption that costs nothing. Beat that. So Wikipedia updates itself 10 times a second. Britannica updated itself 15 times in 2.5 centuries. The orders of magnitude here speak for themselves. Now, can these kinds of disciplines be applied to insurance? The answer is categorically yes. Lemonade is trying to do it. Others are trying to do it. There are many ways in which it can be done. Some of them are fairly obvious. State Farm has 18,000 agents. As a community, Americans pay $50 billion a year to people to sell them insurance. Say that again. We are paying people $50 billion a year to sell us insurance. In the state of New York, homeowners insurance commissions run at roughly 20%, 21% to brokers. which means that you have to increase your premiums by 25% so that you can skim 20% off the top to give to the broker. So it's not hard to see how you can start collapsing costs here by using technology to displace experience that's done today by people. One other element before I wrap it up. The next big revolutions in insurance will come in underwriting. And I said earlier about the risk of your home going up in flames is the risk of your home going up in flames. But let me caveat that. That's not exactly true. Just think about the cell phone in my pocket and how much data it has in it that potentially could correlate to what kind of a risk I am. Is it possible that the way I charge my battery correlates to what kind of risk I am? That if I'm never allowed to drop beneath 90%, I'm a different kind of risk-averse person than the person who lets it drop to 3%? Is it possible that the kind of apps that I choose to download, the kind of phone I choose to buy, the kind of times of day that I make my phone calls correlate? That how much activity I engage in, how fast I walk, how fast I drive, my healthness, how often I post to Facebook, could machine learning find correlates between that beat the FICO score? And the answer is absolutely yes. What kind of organization is going to be able to get that data? It's not going to be the State Farms of this world. They're not present on the phone to start with, and they're not built with the kind of disciplines and with the kind of culture that engenders the kind of trust that will allow me to give them the data in the way I give it today to Google. So to bring it all home, I think that using these diverse fields that I've tried to touch upon, there is potential to transform insurance to an experience that's instantaneous. There's potential to transform insurance to one that settles claims without the kind of hassle and lack of trust that is so pervasive today. And it could be reducing prices dramatically at the same time. Thank you so much for your attention.
Daniel Schreiber, thanks very much, Sam.